This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day, this is Gabriel Shahin, certified financial planner and your host of More Knowledge, More Wealth, here on every weekend talking about all important topics of personal finance. My job is to go over the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of my colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's FalconWP.com for short, where you can go on our Knowledge Center and get a whole slew of great information that was built for you. You sent your inquiries to radio@falconwp.com. That's radio@falconwp.com of what you wanted to know. We either talked about it on air, or if it's quite complex, we built a show or an event or a video on it. And my goodness, we have almost 1 million views just from doing that. It's quite insane when you think about it. So the fact is, we build these for you. And if you want to get this episode and one of our previous episodes, go to podcasts, iHeartRadio, Spotify, you name it, whatever it is, feel free. Now, I'm the president of Falcon Wealth Planning. We are a fee-only, non-commissioned, true fiduciary, folks. We go over all important topics of personal finance. That could be where you are today, how retirement looks like, talk about investments, taxes, estate planning, insurance, folks. You name it. Anything that involves a dollar sign, we can help you with. That's why we're offering a free financial assessment where we're giving 1 to 2 meetings, 1 to 2 hours of our time at no cost, folks. We are more than happy to help. Doesn't matter where you're located. We've got offices all over. And more importantly, we can help you via Zoom. That is a big part of how people like to meet these days. So we've adapted to you to make it convenient for you. And our process and way of doing it is fantastic. Some people prefer it. Even 10 minutes from our office, they still prefer Zoom. So we would love to help. Give us a call. Our phone number, 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short, and you can just click the inquiry right there on the home page. Start off every show like that. You know, we just got a new Chief Marketing Officer here at Falcon Wealth Planning, and we're excited about it because we do a lot of content, like I said, based on what you guys want to hear. And so he said, you know, you should pre-record that whole intro and just replay it every single time. That's like 2 minutes that you could save of a 30-minute show every single week. And I'm like, that's a good idea. But here's the thing. Sometimes the way I do that really sets the tone of how the meeting, or excuse me, how the show is going to go. If it's a high energy, if it's good, it's crisp, it's clean, I know it's probably going to be a clean, crisp show. So we'll see how this one goes. But listen, this has to be a good show. Why does this have to be a good show? The Dow Jones hit 40,000. Wow. Yeah, we can give a round of applause for that, can't we? Now, here's the thing. I only make statements and I only get in arguments I know I could win. Right? I will tell you the sun will come out tomorrow. And by the way, if I lose, then we're all dead, right? Because the sun has to come out tomorrow. And so the idea is I made these comments in summer of 2020. Now, granted, in March of 2020, right, the the Dow Jones was at 21,000, right? Because of the whole COVID crash. Now, just 4 months later, it jumped to 25,000, right? We didn't think it was going to be rebounding in just 4 months. Now, I said at that time on this show, in this platform, maybe with a different backdrop, I don't know. Let's just assume it's the same for those who are watching on YouTube. I said the Dow Jones is going to hit 40,000. It's common sense. I mean, it's not a matter of if, but when. I mean, if you just think, at the time, it was at 25,000. What I said is, let's just say we have a regression in COVID and we go back and it drops back to 20,000. From that point, at a 7% rate of return over the next 10 years, then the 20,000 now will be at 40,000 naturally. So my prediction was conservatively, by the end of 2029, which was 10 years, quite frankly, less than 10 years, at a 7% rate of return, would be at 40,000. Now, I didn't think it would be 4 years later would be at 40,000. But that's just one piece of it. The S&P has actually done better, right? Because the way the Dow Jones, the way they calculate that is price weighted versus market cap weighted, which I think I talked about in a show not too long ago. Or maybe I did it on YouTube now that I think of it, because people have questions on this stuff. So when you look at the S&P 500, during COVID in that March of 2020, dropped to 2,500. Now, when you look what happened in the same July, where the Dow was at 25,000 from 21, it went to 3,200. And by the way, at the peak in 2021, December of 2021, the Dow Jones was at 36,000. The S&P at almost 4,800. We'll call it 4,700. Now, today, think about this. It's already happened much more than the Dow Jones, where the S&P 500 is about 5,300 right now. The Dow Jones is just crossing 40,000. It's actually performed more. Let's be even more extreme here. You have the NASDAQ, which at the time was 7,500. Boy, was that low. 7,500. And then what happened in a few months later, in March of 2020, or a few months later, what happened is it went to 10,000. So from 7,500 to 10,000. Then by the peak in 2021, December of 2021, went to 16,000. Today, it's about 16,700. It actually went up a lot more, right? Over 2.5 times almost. Because each index is a little different. So we're celebrating these milestones. They are great milestones. Personally, I believe, conservatively, I'm saying it here, that in 20 years from now, let's even give my, I know that's going to hit it way before then, but let's just say it anyway. In 20 years from now, and let's give me 21 years, right? In 2045, the Dow Jones will be at 100,000. I mean, I feel a high degree of confidence. That is less than a 7% annualized return over the next 20 plus years. The S&P 500, I think in 10 years will be at 10,000. So in 20 years, 20,000. Remember, that's a 7% rate of return. NASDAQ, I think in 10 years from now, it'll be 30,000. The points will be at 30,000 NASDAQ. And then 10 years after that, we'll be at 60,000. Yet again, 7% rate of return. Every 10 years, at a 7% rate of return, your account doubles. The value doubles. But I think the big question everybody should be asking themselves is, what other investments are out there? By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth here, and every weekend talking about all important topics of personal finance. And so, I talked about a lot of numbers there. Let's just take a big step back. We're talking about 3 indices: Dow Jones, S&P 500, and NASDAQ. Oh, by the way, they're all large companies, all large cap, all large US, for the most part, right? So let's now say, what other investment are out there? And then I'll give you my, should I say prediction? I will talk about these in detail, but I just want to go over the list with you. Because some people think investing is just stocks and bonds. Some people think it's just the S&P 500. That is not the case. Here is the list of investments that people do in their 401k. I'm going to keep it very simple. I'm actually not even going to talk about large cap, mid cap. You heard me talk about that before. I'll keep it very simple. Stocks, bonds, cash. I'll go as far as saying money market. That's pretty much it. Majority of other people out there, you know what else they invest in? Real estate. They buy rental property, commercial property, whatever the case may be, for the purpose of income. That is an income-focused asset. These are asset classes that is taking your money, you're deploying it somewhere else so you can rely on later. It's an investment. So the question that we're going to go over is, in the next 10 years, I'm going to go over a lot of core asset classes here, such as there are hedge funds some people do, private markets like private equity, private debt. I talked about money markets, cash, bonds, stock, real estate. How about commodities like gold? And then you had some crazies out there, which I know the SEC calls it a commodity, but cryptocurrency, we'll call it Bitcoin. I know I did a webinar recently on Bitcoin. Why? Because you wanted to learn about it. Not here pumping Bitcoin here. I hate the damn thing. But you have to give it some attention, right? I mean, if you had a 1% exposure in it in 2018, depending on your risk tolerance of your portfolio and when you bought it in 2018, that would, assuming no rebalancing, could be anywhere between 25 to 50% of your overall portfolio value. I'm not pumping the damn thing. For all I know, this thing can go to zero. The idea with this is, with all these asset classes, what do you think will be best in the next 10 years? The Dow Jones hit 40,000. Whoop-de-doo. It's a nice, even, round number. It's very nice. There's still the S&P 500. There's still the NASDAQ. There's still mid-caps. There's still small caps. There's still international, developed markets, emerging markets. Come on. Like, are you putting all your money in one asset class? Are you buying NVIDIA, putting all your money in Tesla? Are you putting all your money in Apple, Amazon, Facebook, Google? Like, really? Over the next 10 years, what stock do you think will be around? Seriously. Apple? What do you think? You want a Tesla? Amazon? Where was Amazon 10 years ago? Were you using Amazon as frequent as today? Could something new come up and put them out of business? This is why people don't put all their eggs in one basket. This is why we offer a free financial assessment. What worked yesterday may not work today, let alone tomorrow. Folks, give us a call. We would love to take a look at your situation. At the very least, talk about the other options that are out there that people don't even know about. We will offer 1 to 2 meetings, 1 to 2 hours of our time at no cost, folks. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short. All I do is take a look at just what your situation looks like and taking a look at all the options that are available to you, whether it's in a retirement account, in a brokerage account, or just cash that you have laying around. Taking a look at how much cash do you need laying around. Could it be in a money market account earning a higher rate? You like 0.0% or 4%? On $100,000, that's $4,000 a year. You get what I'm saying? That matters, folks. That $4,000 a year could pay for your property tax, pay for your car insurance. It could pay for your utility bills. I mean, just, I don't know. Man, that was a little tongue twister back there. The point I'm trying to say is I'm going to go over every single one of these asset classes. Kind of give an idea of what the high and the low could potentially be. This isn't a recommendation. This is just a thought. This is from somebody in the financial industry who's highly respected, manages close to $1 billion in assets, giving you feedback on what could make sense. Folks, we'll be right back after a few words.
This is Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth. That's on every weekend. We're going over all important topics of personal finance. We're going over retirement planning, making sure you're prepared for retirement, Social Security and strategies, real estate, taxes, avoiding them now and in the future, investments, reducing fees, commissions, and so on, insurance, and estate planning. Folks, we are offering a free financial assessment that you could take advantage of. We have offices all across Southern California, including the Inland Empire. Give us a call to take advantage. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website, falconwealthplanning.com. That's falconwp.com for short. Enjoy the show. We look forward to serving you.
Welcome back, folks. This is Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here. And every weekend, we're talking about all important topics of personal finance here, folks. And I thought, let's just go over all the different investments that people are doing. And so I'll start off with the most simplest ones. And here's the idea. What do you think is going to happen in the next 10 years? I think the Dow Jones will be at 80,000. I think NASDAQ may be at 35,000. I think the S&P 500 may be at 10,000. How do I come to that conclusion? Well, if the market just does 7% rate of return on average over the next 10 years, it doubles. That's why when I made the comment in the summer of 2020 that the Dow Jones will hit 40,000 in 10 years. Oh, I was wrong. Well, I was right. It hit 40,000, but it wasn't in 10 years. It was in 4 years. We had an economic boom that helped. So let's go over the asset classes. I'm going to rank them in what I think is the worst performing asset. And then I'm going to have some asterisks to other ones that are out there. So over the next 10 years, I'm going over these 1, 2, 3, 4, 5, 6, 7, 8, 9 different asset classes. I'm going to go from worst to best. I think the worst performing asset class in the next 10 years is cash. Some people say it's safe to have cash. I say you're losing money safely. It's just sitting there being eroded by inflation. I wish the cash you had, the 100,000, 200,000, the million you had in cash, and when I say cash, that could be cash in the bank, just something earning nothing. I wish you bought the stocks, real estate, gold, something, just not cash. The car has gone up in value. The groceries got up in value. The homes went up in value. Everything went up in value. And your cash is still sitting there, eroding and losing money safely. Worst investment in the next 10 years. Now, when do people think it's a good investment? If they think the market is going to collapse. The gold market, commodity market, real estate market, stock market, everything collapses. So my opinion is in the next 10 years, I don't think that's the best asset class to invest in. The second worst, I'm going to say, is going to be gold. Even though gold has had a really good run recently, I think the commodity piece, when you look at inflation, when you look at everything going around, I think gold should be at 3,500. But because it doesn't work that way, I think it's going to be the second worst performing asset. I don't think it's going to lose money from where it's at. Keep in mind, I'm talking about that at 2,300, 2,400 an ounce. So it has to maintain that trajectory. There could always be a pullback on it as well. So I think that could struggle over the next 10 years. I think it's going to do better than cash, which means I don't think it's going to go under 2,400 in the next 10 years. Might go slightly above. I think the next worst asset class is money markets. Right now, you can get some places, 5% on there. You're getting that today. Your 100 grand is 105,000. Your million is 1,050,000. That's not a bad thing. That will compound. I do see that will slowly decrease over time. That typically happens as we reach peak inflation. As, ironically, money market deposits are higher than bond deposits. Historically speaking, when that crossover happens, bonds significantly outperform money markets. Not just commenting here. I'm not saying you're going to lose money. I'm saying it's just going to not be as good of an investment going forward, which leads to my next investment that I think may be the not as good performing, or I guess you could say better than money market. I think it's going to be real estate. I think real estate right now is at a really big high. It's weird that the cost of renting is cheaper than ownership. Like, it's crazy because you got to think you're putting 20% down for ownership. And it's so expensive because of the interest rates, number one, and number two, the pricing. And we still have a supply and demand area in a lot of major markets out there. There are some regions that have dropped in value. I've seen it. But I think in the next 10 years, I still think it may do better than money market because it depends. Because even if you buy the house and it drops 20% in value, you're still getting a tax write-off. You're still paying down the principal. It's still flat, your payment, assuming it's a fixed mortgage. It's still flat. I think just having that security, built-in equity over time, over 10 years, even if you buy it today and drops 20%, I still think just because it drops 20% doesn't mean like it stays at that forever. Next year it could creep up 3%, up 3%, up 3%. Plus you're getting tax benefits and the mortgage pay down. I think it's beneficial. I really do. I do think it makes sense for there to be a correction, but I still see it outperforming gold over the next 10 years. And I still see you making money. I just don't see you making that much money. The next performing asset, I will say, is bonds. Bonds is like on the lookout for doing well. Why? Because we are in high rates. And when you invest in a bond and you can capture a 4, 5, 6, 7% bond, when interest rates go down, I didn't say if, when interest rates go down, bond prices go up, in addition to the yield that you're getting. This is why it's important to have that type of allocation in your portfolio. It's extremely important. If you notice, bonds historically underperform stocks. Which leads to my next one, where I'm going to put an asterisk under, and that is hedge funds. I don't care for hedge funds. I really don't care to invest in hedge funds in my clients' portfolios. I really don't. It's a lot of unnecessary risk. And Warren Buffett has proved in many bets that he's done that the S&P 500 can outperform a hedge fund. Sure, you can have a year with the hedge fund up 200%, 300%, whatever, but you can lose a lot, and a lot of them have proven to lose. They're great losers. I mean, I'll take a bet with any hedge fund money manager out there over a 10-year period, and I can choose the index that I want to choose. And hey, it's a bet. Warren Buffett does it all the time, and oh, by the way, wins all the time. So the idea with this is it's a mechanism where, yes, you can get growth over time. You might get a 200% year, but a year when the market's up 30%, that thing can lose 50. So I do think that, but there is some validity behind it. So I'm going to say, sure, that can be fine. The next one I'm going to say is the stock market. Stock market averages 10% a year returns. That's not a guarantee. That doesn't mean you're always going to make 10%. Heck, in 2022, you lost over 20%. Depending on the indice, you lost almost 40% within the NASDAQ versus the S&P 500. So it matters, folks, what asset class you choose. But the stock market in general averages about 10% a year. Why? Because these companies' goal is to grow. Your job working is to prosper. It's to ideally make more money, to get advancements, to get raises. And that's human nature for us, is to do things like that. It's the same with the companies. Companies are ran by people. Now, sure, some of them are really greedy. They're not happy with 10% return. They want 30, 40, 50% return. That's why they call them growth stocks. They're currently trading at what they're expected to make in the future. That's why Tesla has had some pullback recently, right? They were saying we're going to get 50% growth year over year over year, 50%. They build all these plants, these gigafactories, preparing for a 50% growth. Now it's looking more like 40% growth. We're going to see what happens after this quarter. It might be slowing down to 30% growth. Like, don't get me wrong, 30% is still good. Company still makes money. I'm not saying go buy Tesla. I'm just commenting why it's dropped from $300, $400 a share to less than 200. So, not to digress, right? So that's stock market. Now, I mentioned Bitcoin earlier. I don't even know if I want to talk about Bitcoin. I don't. That thing can go to zero. What's going to happen in the 10 years? There's so much hype behind it, and now Wall Street's behind it. Yeah, some of the biggest asset managers in the world, like Fidelity and BlackRock, that now have this ETF. I don't know. That thing, I mean, I know there's having, could it? I don't want to make it sound like, yes, it could perform better than the stock market over the next 10 years. I know some of the guests that I brought on, it's like, yeah, absolutely. I'm betting my life savings on it. I don't know. Just seems uncomfortable to say that. So I almost want to plead the fifth, because I understand why you're saying the growth and those emojis of the rocket ships to the moon. I get all that. I do. I just think this thing can go to zero. I don't think the S&P 500 or the largest companies in the world will go to zero. America can get hit by a nuclear holocaust, and Pepsi will still be in business. Walmart will still be in business. Costco will still be in business. Pfizer, you get where I'm going. I don't have to list like all the, Microsoft, Apple, they're still going to be in business. So a lot of their business is international. So I can't say that about Bitcoin. I'm sorry. I just can't. Companies are in business to make money. These are physical companies that people know exactly what they do. So I know Warren Buffett's probably not happy because he only invests in things that he understands. A lot of people don't understand Bitcoin, and it's had a massive run-up. Annoys people like him. Hell, it annoys people like me. But I just wanted to preface that because I'm not going to rank that one. The final one I'll rank is going to be private markets, such as private equities, private debts. You got to think these private equity companies out there, their goal, their intention with these funds are to get like a 10x return in 10 years. Not double, right? Not a 2x return. We're talking a 10x return. Now, the investors don't typically see all that unless they're really in the fund. I typically see people who do these private markets, such as private debt. We have a private debt fund that typically needs a $25 million minimum. We were able to get that for some of our clients. Obviously, not $25 million minimum, but that thing does pretty well. obviously nothing is guaranteed. Some of this is illiquid. You can't even get your money. Maybe you have to wait 3 months to get your money. Some of them you have to wait 3 to 5 to 10 years to get your money. I've seen, this is like the idea of the rich getting richer. They understand these private markets. You got to understand this, for example. If you were to buy the local ice cream shop in the corner because the person is retiring, they net, let's just say, $50,000 to $100,000 a year. What would you pay for it? Well, the value on the street is $50,000 to $100,000. 1 to 2 times what they net profit. Okay, if they make $100,000, maybe max you pay $200,000. So that's a 50 to 100% return on your money. Private equity companies do this on a much larger scale. And they're running these companies. And oh, by the way, they're really good at making it more profitable. They have some more senior management. They have more consultants. They've done it before. They can use some of their in-house technology so they're not having to double dip on expenses. And so they do this also help propel growth as well. They have all this money. You know how to make money sometimes? You got to spend money, right? If you want to invest and participate in the market, you got to spend the money to put into the market to grow. Private markets make sense for a lot of people. This is why we do incorporate them for some of our clients. Now, I don't like the fact that private markets even exist. And we used to have, if you look 20 years ago, almost twice more stocks in the exchange than we do today. Why is it half less almost? Because private markets are saying, don't go to the NASDAQ or the New York Stock Exchange or the NASDAQ. Do it through us. If you want to raise money, do it through us. That is more of a common thing today than it's ever been. A lot of money in private equity. Why? Because of what we're saying. If Tesla's goal is to do a 50% return year over year over year over year, why would they share that with the common good of the stock exchanges? Or they could just do private. Look at how much scrutiny these CEOs are getting versus if they just stay private. Let alone the debt. The bond offerings aren't as it used to be. Some of the bond offerings, quite frankly, you need to raise at least $300 million before even an underwriting firm like a Morgan Stanley or Goldman Sachs will even look at you. Well, you can't go to your bank for that type of money. That's insane. They'll only do maybe max what, 25, maybe 50 million. There's this massive gap between 25, 50 million to 300 million. Private markets are important for that. I think private markets should, by the sheer logic, outperform the stock markets. Now, don't go buying the stock out there because the executives are making tens and hundreds of millions of dollars. These are the specific funds to do that. Folks, this is why we're offering a free financial assessment. Depending on your situation, depending on your goals, depending on how much risk you're comfortable to take, and more importantly than anything, how efficient is it in your overall situation? This is why we're offering those assessments. Give us a call. We'd love it to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help put together an assessment for you to answer these questions that you may have. Because the world of investing is complicated. It could be physical items, such as gold or real estate, or it could be other markets, such as the stocks, the bonds, private equities, and then some even say these hedge funds, whatever the case is. My point is don't discredit anything before you fully understand it and if it makes sense for you. And the question is you may be taking more risk than necessary. You may be putting all your money in tech or all your money in private equity or all your money in something that's just not necessary to do so. What's great today may not be great tomorrow. There's times private equity isn't great. Hedge funds aren't great. Private debt isn't great, let alone the Bitcoin, the gold, the stock market, and the bonds and money markets. You weren't doing money markets 2 to 3 years ago. They were worthless. We're making what, 0.1%? So it's important to know where you're at. Folks, that was a fast show. I want to thank you for tuning in with us. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can get this episode and any one of our previous episodes as well. Folks, go ahead and reach out if you have any questions. We'd love to help. Folks, we want to thank you for tuning in. I want you to have a great week, and God bless.